put these two concepts head to head for a second. On the left, capital represents long-term capacity and multi-year benefits. You're building the business for the future. On the right, revenue represents daily operations and immediate use. You're actively maintaining the business in the present. It's pretty straightforward, right? But here's the catch. If you mix these two up, you completely lose sight of whether you're genuinely investing in tomorrow or if you're just surviving today.
Tracking the money. So how does all this translate into the actual numbers?
The logic behind this is actually kind of beautiful. Because capital expenditures provide multi-year benefits, they aren't just treated as immediate losses. Instead, they're classified as assets, and they live right there on the balance sheet. They are recorded as long-term assets in the company's general ledger because, well, they hold enduring value. But revenue expenditures, since they're used up immediately, they're classified as expenses. They hit the income statement right away, recorded as immediate costs against your current revenue. I mean, think about it. You can't exactly put your office coffee supply on the balance sheet for the next 10 years, right? It's an immediate expense, plain and simple.
Why the difference matters. Okay, understanding this isn't just some abstract exercise for accountants in a back room.
To summarize our core takeaways here, capital spending gives you multi-year benefits and actually builds capacity. Revenue spending, on the other hand, is used entirely within the exact same fiscal period. Categorizing these correctly is absolutely essential for distinguishing true long-term investments from your everyday operational costs. Look, if a company mislabels its day-to-day maintenance as a long-term capital asset, well, they might look artificially profitable on paper today, but they're basically hiding the true cost of running their business. Separating the roots from the daily flow makes sure a company and its investors knows exactly where the money is really going.
Which brings us to a final thought for you to take away from this explainer. This whole principle, it doesn't just apply to massive factories and big corporate balance sheets. It's a really useful lens for literally all financial allocation. So when you look at your own spending, whether that's in your small business, your department budget, or heck, even your personal life, are you planting deep roots that will yield capacity for years to come, or are you just spending money watering today's flowers? Keep that specific visual in mind, and you'll always know exactly what your money is actually doing. Thanks so much for joining me, and keep learning.